Hey, good morning once again, options traders. Well, during high volatility moments in the market, we know that traders like to use vertical spreads, and it could be to mitigate the risk of a spread that you're buying, or maybe to mitigate the risk of an option that you are selling. You'd like to go out and sell this out of the money call option or this out of the money put that's trading at very high implied volatility, but you say, you know what, I don't want to take all of that unlimited risk, so let me buy an option as a hedge. So those are very common strategies during moments of high volatility. But a lot of times traders are trying to do it to collect premium, and they want positive theta. So is there a way to figure out if your vertical spread has positive or negative theta? Now, of course, yes, you could go to your broker's platform and look at a computer screen and you'll get a number. But that really masks the meaning of, first of all, what it even means to have positive or negative theta. Where is that coming from? Well, there's a very simple way to figure out if a spread at any moment in time has positive or negative theta. So how is that done? That's what we're going to find out right now. But as always, before we get started, please be sure to click like. And while you're at it, click subscribe. It is definitely helping to promote the channel and is very much appreciated. So positive or negative theta. Remember that positive theta positions appreciate over time. That's really what it means. When we talk about theta in the options market, typically we're talking about the price decay. That's if you're buying an option, you would have negative theta. But positive theta comes from an option that you've sold, and that will appreciate over time. Now, of course, it sounds like a good thing to have positive theta, to have this option position appreciate over time, but that's assuming all else being constant. There's always a cost. And your cost is negative gamma and negative vega. That is kind of the price that you pay for having positive theta. Now, on the flip side, the negative theta positions depreciate over time. And the benefit is that you have positive gamma and positive vega. You're going to have these deltas that are going to be manufactured in your direction, meaning that if you're bullish, they're going to be generating more and more deltas if that stock in fact goes up, at least up to the amount that that contract controls. So if you have one call option, you might ultimately generate 100 deltas. And of course, with positive gamma comes positive vega, which means that if volatility increases, the value of that option is going to increase as well. So both of those are benefits. And to get that benefit, you have to be willing to expose the position to negative theta. So it's important to understand that there are always trade-offs. So let's take a look at the vertical spread. So recall that this is a strategy where you are going to buy one strike and sell another strike. They will have the same expiration and of course have the same underlying stock. So for example, you might buy the 100-105 vertical spread. So if this is a call spread, it means you are buying the 100 strike call and selling the 105 strike call. Now, to back up a little bit, remember that whenever you buy any option, any long option has negative theta, and any short option has positive theta. So look at this spread. If we buy the 100 strike and sell the 105 strike, both of these being calls, do you have positive or negative theta? Well, it's a little hard to tell because you have one long option and you have one short option. And depending on where that stock is, one of those strikes is going to carry more weight. And that means that that vertical spread could flip from positive theta to negative theta or vice versa. So once again, the thing that we're trying to figure out, is there a way to tell if you have positive or negative theta without looking at your broker's platform? Well, let's take a look at the first and probably the simplest example. And here we're long the 100 strike call and short the 105. And I'm going to put the stock right here in the center at 102.50, dead center between that 100 and 105 strikes. So this red graph is the current curve, and in blue is the expiration graph. So with the stock right here at 102.50, let's say that our broker's platform says that the $100 call is trading for $4.31 and the 105 call is worth $1.88. Now that's exactly what those options would be worth without any skews. Those are generated from a pricing model. And therefore the spread would just be the difference between these, $4.31 minus $1.88. So the spread would be trading for $2.50. Now, does this spread have positive or negative theta? Well, there's a couple of ways to figure this out. And one is to just pretend that we are at expiration. So if we're at expiration and we're on the blue curve, the bell's about to ring in 2 seconds, that we know that the stock is 102.50, the $100 call is therefore worth $2.50 of intrinsic value. The 105 call goes out worthless. So if the spread could be sold for $2.50 and we paid $2.50, we didn't really depreciate, we didn't really appreciate, we're just right here in the neutral zone. And that's because if you remember from the video on premiums and discounts, we are buying this right at parity. We have $2.50 of intrinsic value, and that is exactly what we're paying for the spread. So in this case, we're not going to experience any time decay at all. But what if we found that the stock was, let's say, up here at 103? Well, we might look at our broker's platform and find that the $100 call is worth $464, the 105 is worth $208. So we still have everything constant. Let's say there's 30 days to expiration. All we've done is we've moved the stock up a bit. And we're going to find that this spread is now trading for $2.56, a little bit more than what it was when the stock was at 102.50. Now in this case, you are going to have positive theta. And there's again a couple of ways that we can figure this out. The first is to say, let's pretend that we're at expiration. And therefore, with the stock at 103, the $100 call is worth $3. The 105 call goes out worthless. So if you paid $2.56 and it's worth $3 at expiration just from the passage of time, it's appreciating over time. So that's one way to figure it out. Now another way, if you happen to have a risk graph like this on your broker's platform, we know that this is the current curve in red. Stock is right here at 103. And so we can see that this red curve is going to move towards the blue in that direction towards expiration. It's appreciating. The value of the spread is moving from this red point right here up to this in blue. So that's a good way to visualize if it's going to appreciate or depreciate over time, but you would have to have some risk graphs to actually see that. All right, let's try another one. Let's put the stock down at 101. We look at our broker's platform. It says the 100 call is trading for $3.40 and the 105 call is trading for $1.37. The spread once again is the difference between these, or $2.03. But now I can tell that we have negative theta. How can I tell that? Well, again, there's two methods. The first method is to say that the stock is at 101, but we're at expiration. And if the stock is 101, the $100 call is worth $1. The 105 call, as before, just goes out worthless. So if the spread is $2.03 today, and it's moving towards a price of 1, it's depreciating. It's going to lose $1.03 from the passage of time. What's the second method? If you have a risk graph like this on your broker's platform, the stock is right here at 101, and we're on the red curve because we haven't expired yet. But remember that this point right here on the red curve moves towards the blue. Well, there's no blue up here. We can see the only way that it can move is right down here. So we can see that this red line is sinking lower towards the blue as time passes. So this is another way to figure out that your spread has negative theta. So those are some fairly simple ways to figure out if your vertical spread has positive or negative theta. And of course that could change as the stock price changes, and that can help you to make decisions about whether you should stay in it or perhaps shut it down. But this is also a very good example of why it's so important to understand your options theory, because if you understand how options behave over time and as stock price changes and the volatility changes, you'll have a much better understanding of what to expect from your strategies. And when you do that, it can only lead to better results. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Options A to Z's Facebook trading group, and you can find a link in the description below.